Welcome back. Somber morning. And now the all-important GDP number for the third quarter, that is October-December 2024 quarter, comes out today. I say it's all-important because we have to embrace the fact that Indian stocks have been falling, not just because of the global tariff turmoil or US exceptionalism, but also because India is seen to have lost its growth momentum. The second quarter GDP of 5.4 and the second quarter corporate earnings growth below 5% has rattled investors. Funds coming into emerging markets are preferring China over India, given the worries over India's growth. All this makes today's number very important. The CNBC TV18 poll sees the GDP for October-December to have grown 6.2%. But let us ask the experts who have joined us, Upasana Chachra, the economist, India Economist from Morgan Stanley, and Suvodeep Rakshit of Kotak Bank. Suvodeep, Upasana, thank you very much indeed for joining us. You know, both of you have numbers below my poll, and I thought my poll was very low at 6.2. Okay, let me start with you, Upasana. Only 6%, right, is your number. What are you seeing as the key weaknesses?
Yes, Latha, we are tracking GDP growth at 6% for December quarter, but the GVA, which is the growth through the industry agri services segment, will be higher at 6.2. So there is a rebound from the September quarter levels, and there will be support that we see growth gets from agriculture, some improvement in manufacturing, and pick up in government spending, while consumption we expect will be more or less sort of steady versus the previous quarter. In terms of drags, I don't think I'll call it as a drag on growth. It's just that growth recovery has been a tad weaker than what we were also probably anticipating while we were in the December quarter. The recovery in manufacturing segment and also the pickup in government capex spending especially has been a little back-ended. And that's why I think the growth numbers for December or our estimates are a little lower than where consensus is pegging it at.
Well, likewise for you, Suvodeep. Well, I thought the government came in and spent with a bang in December. It overturned the capex fall. As well, construction picked up a lot. Bombay seems to give you that impression. So, you know, if agriculture, construction, government is good enough, it still doesn't pull it up to a 6.3 or something closer to the RBI number?
So I think, Upasana pointed out two numbers, 6.2 and 6%. And let me just dwell upon that fact. We have a number of around 6.4, 6.5% on the GVA and a much lower number on GDP. Just to understand on the GVA front, you have the manufacturing sector, which has been boosted by a decent pickup. And I'm comparing it with the second quarter number. A decent pickup in the corporate profit, especially from the larger contributors such as petroleum products, automobiles, metals, chemicals, etc. Now, that's a pickup in the profit growth, which will kind of reflect on the manufacturing side when we look at it from the GVA. Agri-sector growth should be stronger, given that the first advance estimate for the Kharif production has been on the stronger side. Construction sector, as you pointed out, if you look at the steel production, steel consumption, or the cement production trends, that has been has a decent pickup. Also, the pickup in the government spending, as you pointed out, also will play a factor. Now, services will be a bit of a mixed bag in my view. The financial sector growth has been hampered to some extent by the slowing credit growth, right? Urban consumption has been muted, as has been pointed out by a number of the companies, and which is also visible in the GST growth in that quarter, slowing down towards a single-digit number. And that would weigh on the wholesale and retail trade to a great extent. So a GVA growth possible around that 6.5% handle. And also we have to assume that the bases are not changing, because if you recall, the bases were changed by 30-40 basis points, and we had all the revisions which were moving higher. Now, the bigger question is on the GDP estimates. Now, if you look at the subsidies payout, and we have limited information when we are looking at these numbers, subsidies payout growth has outpaced the indirect taxes growth, right? That should lead to a negative gap. My view is that it should be roughly around a 30 to 40 bips of gap that you should see at least between the GDP and GVA. Of course, we'll see what the actuals are. So hence, if even if GVA is towards closer to a 6.5% handle, let's say 6.4, I would expect a 6% on the GDP growth. in terms of the gap.
Subsidies payout was higher, you're saying?
Yeah, subsidies growth was higher. So last year, the payout
last year was a
lower.
big fall. Yeah, fair
Yeah,
enough.
yeah.
So that's going to come back to bite. Upasana, anything on the from the expenditure side that you would watch out for, either private consumption or gross fixed capital formation? I thought net exports would be a decent number, wouldn't it?
So on the GDP by expenditure side, I think if we look at the key to watch would be consumption, given the share in GDP.
Yes.
Consumption, though, I think will have a sort of steady trend, as Suvodeep also mentioned. Urban consumption in the last quarter was muted, but we are seeing signs of pickup on rural, or rather rural sort of sustaining some improvement that has happened in the last few months and is building up with the improvement in the kharif or summer crop production as well. So I think consumption supported by rural demand, but urban being a drag, and therefore we see that steady. Capex, I think, will pick up. So yes, as you mentioned, December monthly number for government capex was stellar, 3 times higher versus the average run rate of spending in April to November in terms of INR billion. Pick up in manufacturing related sector profits as well, which should sort of correlate with improved capex on the expenditure side. And on net exports, I think it'll be probably a mixed bag. We are seeing pickup in the services trade surplus.
Exactly.
While merchandise trade deficit was, impacted by the revisions as well, but has been a little higher in the December quarter. So I think current account, if you just balance it out with the current account deficit number, that would probably be making it sort of steady, in my view, in terms of net exports for the December quarter. I don't think it'll be a big boost to GDP numbers.
What is the exact consumption number you're going with? Gross? I mean personal final consumption expenditure.
Yes, so I think private final consumption, I'll keep it steady with September quarter. Again, minus any revisions to the base in terms of YOY. Government consumption, yes, probably some pickup given the government spending has picked up.
Okay. Rakshit, train our eyes. What should we watch out for when the numbers come?
See, a couple of things. I think, so first of all, there are 3 data points that will be coming out. And I'm calling them data points, so they are data releases. One is the third quarter GDP GVA print.
Yeah.
Within that, we need to watch out for what's happening in manufacturing services. Agriculture should be good. Second, we would be looking for is on the consumption versus investment. What is moving, what is not. That's on the third quarter print. And what kind of a pickup are we seeing from the second quarter base? The second part is we are going to get the advance or the second advance estimates for FY25, which was pegged at 6.4%. We'll have to see, depending on the third quarter numbers, as well as the revisions for the past years and the first and the second quarter numbers, where we are standing in terms of the FY25 numbers, right? Whether we are, or whether the government is looking at a further acceleration towards upwards of 6.5% or lower, right? Our number for FY25, based on what we have right now, is around 6.1%. Right.
Oh.
So that's where we are in terms of because of the GDP numbers that we have of third quarter at around 6%, and a slight pickup in the in the fourth quarter.
Okay.
Now, the third part is in terms of the revised estimates on the FY24 numbers, and within that, I think we broadly know the numbers. What's important is we'll get the numbers on the savings and the investment. So what's the savings rate? What's the investment rate? We know the gap, which is your current account deficit, which is 0.7% of GDP. So not much change is expected on the savings and the investment front compared to past years. However, important to note the number and the breakup where we are talking about, what the private sector is saving and investing, or the household is saving and investing, and the government too.
Okay. Well, fair point. And this is something which I hope viewers take on board, that we are going to get the first revised estimate of FY24 and the second revised estimate of FY23. And any change in the base numbers can impact the numbers, which led one former Reserve Bank governor, Y.V. Reddy, to quip that central bankers in all countries, are impacted because the future is uncertain. In India, the past is also uncertain. So we are going to face, any big changes. Upasana, are you at all convinced that we have seen the bottom of the growth pace and that FY26 promises to be much better?
See, I think from the December quarter numbers itself that we'll get later today, probably that will come as a reassurance that growth made a trough in the September quarter itself. And, we've had this discussion with Suvodeep has mentioned about the gap between GVA and GDP. And therefore, the underlying growth momentum, if we were to track through the GVA measure, which is also a more stable sort of a data set when you're looking at growth rates for India, will indicate that as well, that, there is a pickup in agriculture growth, there is a pickup in industry, and services is sort of holding its ground with some sort of mixed trends within the sub-segments within services. So I think trough, yes, surely made growth recovery also happening. For fiscal 26, our numbers are at 6.5% currently. We do think that domestic demand should be able to offset the risks that we currently see from external demand. I'll just mention, I think there are probably three drivers to growth that we
Oh, sorry, the video froze. But I guess we know the drivers to growth. It is private consumption. Hopefully the budget has spurred it. And there are, of course, rate cuts and easing, liquidity easing, regulatory easing by the Reserve Bank. Unfortunately, out of time. Suvodeep, just two numbers. What is your Q4 number and what is your FY26 number? Just the numbers, please, out of time.
Q4 would be closer to 6.4% and FY26 we are, as of now, 6.4%.
Okay, so 6.4, 6.5, hopefully the worst is over. But today's numbers are very, very crucial if you want to put behind the feeling that India's growth momentum is gone. Wrap up on Bazaar, chat process coming.